let's go ahead and talk about what we can do for Alice. Alice is about 4 positions open, a bull put credit spread on META. It is losing money. We're in a 5-point spread. She sold the 135 put and bought the 130 and took in a 90-cent net credit. So the true risk is 410. Let's just take a look at our profit and loss chart for this position. Now, she's losing on this trade, and it's 35 days out in time. It's further out in time. You know, I usually like to go 12 to 14 days out in time, but that's perfectly fine. Although this position is showing a liquidation loss, and no one likes to see that in their portfolio, I would still be following my personal 1% rule, meaning if the stock fell, which I think it did today, down to 136.50, then I would have considered maybe adjusting the position. Or if the maximum loss was at 50% of the true max risk, or 210. We're only at a loss of about 90 there, so I'm not at 50% loss. It did hit the 1% rule, but it recovered after that. The technicals are probably going the wrong direction, but in this case, Alice, I'm holding on to this position, likely not adjusting it at this time. I'm setting my alert in my portfolio for the 136.50. Maybe I just call it 137, maybe 138 in uncertain markets. I know it breached that today. But at this point right now, with 35 days to go, although it's showing negative, I don't know if I'd adjust this yet. We could see more damage on Monday. Of course, we know that. We could see more damage next week. We know that. But in this case here, with this particular bull put credit spread, I haven't hit all my triggers that we discussed for the 8 ways to manage a bull put yet, so I'm probably still holding on to this one. But like I said with the SPY bull put, when it got near that 1% or breached that 1%, I probably would have been adjusting the position. All right, so that was the bull put credit spread. Those are my thoughts on that. Zim, a 75 October put sold for 133. It's slightly in the money at this point, and we're looking at a loss of 370 or 4.9%. All right, so the Zim short put now, I might consider rolling. It's in the money. The stock has dropped below my put strike price. Well, how would I evaluate it? As always, as I'm tracking positions in the portfolio, I'm going to go to position actions and position analysis. This gives us a breakdown of our current position, where we stand right now, time value remaining in the option itself, the delta. My current liquidation value, a loss of 370 or about 4.9%. And if the stock stays at the same price, 74.45, yeah, good luck with that. We know we're going to be volatile for a little bit with ups and downs, but if the stock stayed at 74.45 for the next 28 days to October expiration, you'd have to close your 75 strike put for 55 cents, but you took in 133, so you'd still have a profit of $78 or a 1% yield on this position. But we're concerned now. The stock has dropped below our put strike price. We know it's going to cost us $503 to buy it back. We only collected $133 or so. And as we see below here, we have opportunities to roll out in time or down to lower strike prices and still have a positive net credit with a positive return. Of course, the deeper you go out of the money for protection, the lower that return is going to be. But we could go further out. We could go out to November and go down to the 75 strike put and still make a 1.9% yield on the position, taking in the 133, buying it back for 503, and then rolling it down. We could still have a positive adjusted naked yield on this position. And the same thing here with going out to December. But I'd focus maybe on November in this case, rolling out there 56 days out in time if need to, or maybe to the November 4th, 42 days out in time. But you've got opportunities to move down to readjust this position. This is how I would evaluate it, Alice. I don't know which one's better than the others. Or you could just liquidate and take the loss, but I don't think that's what you want to do right now. You could evaluate the other rollout opportunities and other positions there to see what's available. Now, your other one, it was a SE put, October 50, and the stock's at 53.81. You collected $395 for the position. It's at 257. This is the one that's at a profit. It's doing what you want. Leave it alone. Maybe set an alert at the 1% rule. 50-50, same as the bull put spread. $50.50. That means if the stock hits 50.50, I'm going to consider rolling it down. I'm going to use the position analysis view to see what rollouts are available, what matches my sentiment of this stock or the market going forward for the next period. How do we set an alert? Here, just in the alerts column, we'll click on view next to the SE position or any of these positions. And I'm going to set my stock price limit, lower limit, to be 50.50, my 1% rule. I'm going to make that a red warning that something is going wrong that I want it to go against. Now, we could set it also based on earnings, on delta, if you wanted to do it that way, remaining time value, in the money. If we're less than 1% in the money, I could set that too. That's also my red alert. I'm just so used to doing I had Greg add all these features and the programmers add all these features for delta limit, in the money, out of the money limit for the different strategies. I'm still caught in my ways, and I still setting the monetary limit on the stock for my bull put credit spreads rather than using the 1% rule that we've set there. But in any case, let's save alerts. And now if anything is triggered, it will show up. I think I set that wrong anyway. Now the big one here is TQQQ, Ultra QQQ. We've sold a far out December 1630 put. This might have been a rolled position, I'm not sure. But the price was $441. And now the buyback cost is $960. So we're losing a fair percentage on the position. Well, a fair percentage of the premium we collected, but it's a 17% loss, which is also we want to avoid compared to the monetary requirement of the 30 strike put. So we're $870 in the money right now. So again, we'll go to position actions and position analysis. We'll scroll down to our rollout opportunities. Yeah, we were 17.3% loss. Time value decays out. It'll be a 14.3% loss in December. TQQQ is probably not going to be trading right at 21.31. And if it is, it went through a lot of fluctuations between now and December expiration. But we've got some potential rollout opportunities that are available for us. Some of them are right at the money, or some of them are still deep in the money, but some of them are just out of the money. So we took in 441. It's going to cost us $960 to buy this back. We could sell a January 23.75 put for $563. Now, this is an adjusted yield of only 1.9%. But what is it not? It's not a 17% loss. Could the stock still fall against us? Yes. That is a possibility. Of course, now you could roll down to March, and March 23 is a 3.3%. Why am I not seeing the out of the money going further out to the 19 strikes, to the 18 strikes that are out of the money with the stock now at 21.31? And that's because they're not profitable. Rollout opportunities typically will only show positions where you could roll for a profit. We can't roll to the out of the money strikes unless we maybe went out another 5 or 6 months in time, Alice, which is a possibility you'd want to analyze. Is there any magic way to repair the short put now aside from rolling? Well, other than maybe creating some kind of wild butterfly position and get really elaborate, I don't think so. Rolling down is probably the best bet at this point, or it is an ultra, meaning that it's going to swing wildly. So if the market starts to recover next week, this could easily come back to 24, 25, maybe higher. You'll see better roll opportunities at that point. That takes the chance, though, doesn't it? It takes the chance that it continues to fall, or it takes the chance that you get assigned early as it goes deeper in the month. But this is the December series, so it's not as likely that you'll get assigned early, even though we're 8, 9 points in the money. What do I mean by a butterfly? We already have the December 30 put sold. So we sell another one. And so that would be 4 and 9 is 13. Oh, that's really difficult. I don't think it's going to work. Yeah, that wouldn't work. Okay. Whew. So it's 13. So I buy this one for 11. And I buy an 18 put for 2. That would be right at break even, wouldn't it? So we're going to sell another 30 put and buy these 2 outer wings to create the butterfly. And I'm under, oh, okay. Oh, because the wider strikes. Okay, now this doesn't really help us. Okay, this is a bad example. I'd probably roll down and create a butterfly. But it's complicated. Alice, and that's why I'm not really recommending the butterfly as a repair in this situation. So the options here for the one that's really hurting you, SE is in a pretty good spot right now. Set the 1% rule. Zim, you saw some rollout opportunities there. Good opportunities going down to maybe the 73 or the 70 strike if you think the market's settled and you're still kind of neutral to bullish. If you think it's opposite, you might want to do a different sentiment strategy to manage this position. I don't think you can convert this into a bear put debit at this time. No, the prices would be too high. We'll take a look at that in just a moment. The bull put credit spread, it's in a good place. Keep the 1% rule in mind for the short put strike price. You might consider rolling down the short put if it starts to breach that. Rolling down the put, review the webinar that we have both in the webinars page here under the option strategies sections for 8 ways to manage a bull put, or you can look for it on YouTube as well. TQQ is the main one. You want to consider an adjustment on that. There's not a lot that can be done now with going out of the money, going below the put strike price, unless you go maybe 4 or 5 months out in time. We saw that in the rollout opportunities. However, it's an ultra, so it may recover, and you may be able to do that. You may be able to close this put for the loss and then create a butterfly at the current strike prices. You're realizing a loss of 519, so you're going to need a net credit higher than that, but now you've got 2 ways to lose. And that's why I said, Alice, it was kind of complicated on the butterfly adjustment. Another thing with Zim, if you like the stock, you're 28 days out, but you could just hold this here, and if it gets put to you, then convert it to a covered call or a collar position, depending on your outlook for the market. Use the analysis there. The bull put's looking good. Wait to see what happens, of course, obviously on Monday with Zim. It might go back up above 75, but you're still within the 1% rule, so you might want to consider rolling that out based on the rollout opportunities that are shown. And SE is looking pretty good where it is. What did I mention? Oh, bear put debit spread. Let's take a look at the profit and loss chart. We took $1.33 in initially. Stock is below our short put strike price. We've already sold this for $1.33. So if I buy an 80 and it's less than $6.33, which it won't be. Nope, $8.45. Yeah, so these are all too expensive now to create the bear put debit spread. If we buy the 80, no, it's not. No, it's not. Yeah, so I need it to be less than 6, and it's not. So we'd buy that. We have a debit of $7.29 on a 5-point spread, so it's a guaranteed loss. Oh, I picked the wrong expiration. You're the 21st of October. I'm sorry. That looked like a calendar, and that's not what we wanted. But the bear put debit, I don't think. Let's check the 21st. So what do I need here? 5-point spread. Yeah, it's 790 to 820. It's still not there. The 3-point spread is still not there. That'd be a 430 debit for a 3-point spread. You wouldn't get it back, but let's just take a look at that one now. Yeah, that one doesn't work too well either. All right, so anyway, Alice, I think rolling down the ZM one is your best bet, if and only if you still feel confident in the market, you have a neutral to bullish outlook after what we went through this week, you think things are going to settle, and you think ZM is going to be good for you longer term. In that case, for that kind of structure of the trade, wait to see what happens on Monday. It could bounce back above 75, but I still might consider rolling it. SE is good. TQQQ is the one that needs work. Meta, I think you're okay holding on the bull put credit spread right now. So Alice, I think that helps out. I hope that helps out. Excuse me.